This may be one of the best businesses in the world. It's at a decent price, it's got great cash flow right now, but is this stock a buy? Let's analyze Google or Alphabet stock the Warren Buffett way. So yes, it is arguably one of the most impressive businesses in the world. Literally, the name of your company is a verb for searching the internet. It's a verb to the answer for a question. It's a verb for information. Just take a step back and imagine that you own a company that basically almost anyone in the modern world uses on a daily basis and almost needs your company to function with their day-to-day life. Imagine a world without Google. People wouldn't even be able to find out where they live. It's kind of like the brain of the modern day world. And guys, that is an incredibly powerful business model. Even Warren Buffett would salivate at the moat that Google has over its competitors. I mean, who even are their competitors at this point? This is why so many super investors own Google stock. Right now, 30 super investors own Google's Class C stock. The notable ones include Lei Lu, colloquially known as the Chinese Warren Buffett, David Tepper, one of the highest earning hedge fund managers, and Seth Klarman, he's a well-known value investor. So what do you want to start with? The revenue streams, the financials, the intrinsic value? I think let's start with the revenue streams, and let me tell you why. When you buy a stock, a value investor views it as buying a business, not just a ticker symbol on a screen. I'm a value investor. There's different ways to play the market, but to me, value investing makes the most logical sense. Let's say you were to buy a business on the street. One of the first things that you would want to know is, how does this business make money, and will it keep it making money in the future? How much? When we look at Google, the business, we can break its business model or revenue streams into 5 key segments. The main one comes from Google Search. This is worth 58% of their total revenues. Google Search is so important to the modern day business. Google knows this, businesses know this, and thus Google charge a hefty premium if you want to place ads on their search. So let me explain. When you search something in on Google, let's say how to start an online business, the first thing that will pop up is some sponsored websites. These are links from companies that have paid Google to have their sites appear at the top of the search. This works for cafes. If cafes want to advertise themselves, cars, clothes, construction, credit card agencies, whatever business you can think of that wants to advertise. Essentially, it's a key way businesses can reach their customers, and they are willing to throw big dollars at Google to have their business come first to the eyes of their potential customers. So that's the main way that Google make their revenue. The second way they make their money is from their advertising revenue Google gets from their network members. This accounts for 12.3% of their revenue. These are non-Google websites and apps that show Google ads on them. For example, let's say you have a blog. You can use Google AdSense to put ads on your blog to your readers. You'll keep 68% of the money made from these ads, and Google gets a nice 32% slice. It's a beautiful business model because they don't have to make content and attract viewers to the website. They just host the platform and receive the money in a nice passive way. 3, we have YouTube. This makes up 11.2% of the revenue. So if you don't know, Google own YouTube, which they acquired for $1.6 billion back in 2006. And I'm sure you kind of understand how YouTube ads work. There's often an ad, or an ad too many, as I'm sure you can attest to, placed throughout YouTube videos. This is companies paying YouTube to advertise their business. Now, the creators of the YouTube video keeps 55% of the ad revenue. YouTube take a nice passive 45% for hosting the platform. It's such a good business model. Literally have other people create content for you and you just constantly collect a free check for basically doing no work and just maintaining the platform. Fourth, we have Google Other, accounting for 10.9% of the revenue. So this includes their Play Store revenue, which they make through a service fee, as well as taking a slice of the app sale when an application is sold. Google Other also includes hardware sales, and interestingly enough, YouTube paid members don't come under the YouTube segment, but they come under the other segment. Not sure why they calculate it this way, but maybe they want to separate the advertising revenue from the rest of the revenue. The fifth key segment of how Google makes money is through Google Cloud. This accounts for 7.5% of their revenue. Now, I want to put a bit of time into this section, and I'm going to tell you why. Cloud computing is such an important industry, and in the future, it's going to be even more important. By 2030, cloud computing is expected to be a $1.6 trillion industry. Today, it is worth $450 billion. It's going to triple in size in 8 years. If Google can even get a snippet of this industry in the future, it will make them a lot of money. I never used to understand, what the heck does cloud computing mean? Just the whole idea of it sounded very foreign to me, but it's actually simple. Essentially, it's using other people's computers and computing power for your business or for your personal needs. For example, you go to Google and say, can I please use your massive computing network to build my website on? And Google might say, yeah, you can use it, but we're going to charge you money for it. Simplistically, that's the cloud computing business model. And with cloud computing, there are three main players in the game: Google Cloud Platform, Amazon Web Services, and Microsoft Azure. So right now, the two biggest players, Amazon with 33% of the market share and Microsoft with 22% of the market share. Google, right now, they have around 10% share of the market. So if they can maintain a 10% market share by 2030, this segment should be worth $160 billion for Google. Now, in terms of which platform is growing the fastest, it does appear that Microsoft is doing really well. They are gaining more market share as time goes along. Amazon is holding their share of the pie, and Google is doing pretty good. Each year, they're slowly getting more of a percentage, while IBM, the dinosaur of a company, the granny, slowly gets less. You know, Google, they are not silly. They know how big cloud computing is going to be in the future, and they are throwing a lot of money into this industry to establish themselves as one of the big players. Don't sleep on this segment because it could be huge in Google's future business model, and if you buy the shares, you will be an owner in this business model. Okay, now that we understand the business, let's look at the financials now. I'm just going to point out what's interesting and important to know as a potential buyer. So the top line, it's been nice. It's a nice picture. Every year, the revenue has been going upwards. It's kind of in line with the bull market that we've seen. It did really well in 2020 and 2021 due to advertising and search doing very well. But that number has slowed down and it's constricted in 2022. What I found very interesting about Google's revenue picture was that in the 2008 financial crisis, they were actually able to maintain their revenue while other companies were falling. Their business was falling, Google was maintaining themselves. But after the financial crisis, that is when their top line revenue took off. It will be interesting to see if something like that happens in and after 2023. Now, if we look at profit, which is arguably the most important metric to look at because it's actually what you keep at the end of the day, that's basically shown a similar trend to revenue, consistently growing all the way up until 2022. Then the economy constricts, Jerome Powell goes mad hawkish, and profit goes down. Overall, I do like the picture of both the top line and the bottom line for Google. Price to operating cash flow is another nice metric to look at because it gives you a feel for the actual price of the stock over time relative to its value. So the stock's price has gone down a lot since 2020. It's now sitting at a price to free cash flow of 20.5. The last time that it was this cheap was all the way back in 2016. Return on equity is 27%, very high. So this metric measures how good a business is at getting money and turning it into more money. So I'm very happy with that high return on equity. The last interesting thing that I will say about Google stock financials is they have a lot of cash on their books. Currently, they're sitting on $116 billion of cash. So straight away, when you buy shares of the business, you get your percentage of that cash. That is really good, and considering that total debt is $29 billion for Google, that is very low. It shows you that they're managing their money well. They've got a lot of cash and tiny amounts of debt. If you don't know the value of something, then how will you ever know if that something is underpriced, overpriced, well priced? This is why it's important to be a value investor and know how to calculate intrinsic value. By the way, I do use Warren Buffett's method to calculate intrinsic value, aka the true value of the stock is the sum of its future discounted cash flows. We get the cash flows in the future and we discount them back to today. Google's current cash flow per share is $4.71. Analysts expect this to grow by 9% over the next 5 years. So let's plug that in. Now I've got a terminal value with a PE ratio of 15. So right now Google's current PE is 18. So I think 15 is fair enough. And I've got a 10% discount rate as my required return. So this gives me an intrinsic value of $90 per share, which is basically around the stock's price today. So a 10% return for good quality company. I do not mind Google stock at all. The numbers, I gotta say, I am pretty happy with. Now let's do a bear market case. Let's say that cash flows grow by absolutely nothing. Well, then the stock is probably overpriced. And then the bull market case, let's say that they can grow by 20% over the next 5 years, which is actually less than their return on equity, while then the company is massively underpriced in that particular case. But from my calculations, the most probable case is Google is currently around fair value with a 10% annual return if you pay the current price. So that should give you a good rough idea of what you need to know before you buy/don't buy the stock. I do things the Warren Buffett method, the Warren Buffett way. I look at things like a business owner. I study the business model, I study the financials, I study the intrinsic value and all of the important metrics. Realistically, this is how you should look at a stock, because this is what a stock is. It's not some random ticker symbol, it is a business. Most people don't look at it this way. They view it as a ticker symbol, but guess what? Most investors, they get terrible results compared to the market. Google is a great stock, a great company. The business model on it is amazing. It's like the brain of the modern day world. I like the numbers, and I don't think you can go too bad with owning it over the next 10 years. Guys, if you do want to see my portfolio, feel free to join the Investing Academy in the description below, and we can go even deeper into talking stocks. I'm hungry now. I'm going to go Google where I can buy some food. I hope you enjoyed the video, and we'll talk more soon.